On February 19th, 2026, an anonymous user on Reddit posted a thread with the following title. I let my parents convince me to skip my company's 401k for 3 years because they said the market was about to crash, and I will never forgive myself for it. He goes on to explain what happened. Quote, I'm 38 now, and I genuinely cringe thinking about this. When I got my first real job with benefits at 28, I was excited to start contributing to the 401k. My company matched up to 5%, which everyone on this sub would correctly call free money. I mentioned it to my parents at a family dinner, and my dad, who has strong opinions about everything financial despite never actually investing in anything except a savings account, launched into this whole thing about how the market was overvalued and a correction was coming any day now. He said it would be smarter to wait and buy in at the bottom. My mom backed him up completely. These are people I trusted, and I was 28 and I didn't know enough to push back confidently. So I enrolled, but set my contribution to just 1%, just to get the account open, and I told myself I'd increase it once the crash happened and the prices were low. The crash my dad predicted did not come for another 3 years. And when it finally did come, I panicked and dropped to 0% contribution for about 6 months because my dad said to wait for the bottom. By the time I finally started contributing properly, I was 31, and I had missed 3 full years of the 5% employer match, plus whatever growth that money would have compounded into over the following decade. I sat down last month and ran the numbers just to torture myself a little, and the rough estimate of what those 3 years cost me in today's terms, assuming average market returns, is somewhere between $40,000 and $55,000. My parents were obviously not trying to hurt me. They genuinely thought that they were helping. But financial advice from people who love you and sound confident is still just a guess. And the cost of a bad guess at 28 is something you're paying at 38. End quote. 3 years, somewhere between $40,000 and $55,000 gone. Not because he was reckless, not because he was lazy, but because he listened to advice that sounded wise, but wasn't. His parents loved him, they meant well, but in investing, good intentions don't protect you from bad advice. And the painful reality is that mistakes in investing don't just hurt, they compound. So today we're going to talk about the cost of bad advice and how to make sure the voices shaping your financial decisions are actually worth listening to. Welcome to Plan to Prosper, where we exist to honor God by helping faithful servants steward their finances wisely and build wealth that endures for generations. All right, Logan, here for another episode.
Yep, we are back.
Yes. How are you doing today?
I'm doing well. It's kind of dreary outside, but other than that, doing well.
Yeah.
Woke up to a kid at 4 a.m., so...
That's fun.
I'm already down 1 cup of coffee, but yeah.
That's how it goes sometimes.
Exactly.
I'm feeling a little under the weather today, but I'm also kind of, as you mentioned, over the weather because it's been really dreary the past few days.
And you're sitting across the table from me about to get me sick.
Mm-hmm.
Oh, man.
Well...
My kids are finally good, and now Dalton's going to get me sick.
Well, my kids probably got it from your kids, who then gave it to me, and so you're probably immune to it already.
That's fair.
So we're looking today at this story that I saw on Reddit a couple weeks ago. This guy posted, and I thought it was just a helpful thing for us to think about that even one piece of bad advice can set you back quite a bit. And in this case, it's not the worst financial story I've ever heard. But nevertheless, it set him back and cost him tens of thousands of dollars. And we'll look at some examples that you gave of even more specific numbers depending on different market returns. But this idea to wait for the crash before you start investing in the 401k was, I think there was good intentions on his parents. His parents weren't trying to hurt him, but it was ultimately pretty bad advice.
Are you a big Reddit guy?
Not really.
Okay. Yeah, I've never really gotten into it, but yeah, interesting. So you found this a few weeks ago?
Yeah, I first saw it. Somebody, a financial advisor, posted it on LinkedIn, like a screenshot of it, and commented on it. And then I hopped on Reddit to just see what people were talking about in the personal finance world. And this one came up, and I was like, oh, you know what? This is a good idea. Let's dive into what sounds like good advice, but it turns out to be bad advice. And how do we think through this and help people from preventing those kinds of mistakes? Yeah,
definitely. Sounds like they were well-meaning.
Yeah.
But kind of spoke, sounds like they felt like they knew, they thought they knew too much or knew more than they actually did.
Yeah. I think the key insight that this kid really missed on was when he said his dad's never invested in anything except a savings account. So,
did it say that?
Yeah.
Wow.
His dad's not exactly this look at this beacon of success in the investing world. Like he clearly knows what he's doing. Like he's never even done it. So I don't think that's a person that you really should, as much as you probably love your dad, of course. that's not somebody you should be taking really like specific financial advice from.
Right. Yeah.
Proverbs 15:22 says, plans fail for the lack of counsel, but with many advisors they succeed. And we want to just think through today. We're just going to basically break down the story, what happened, where it went wrong in these various pieces of the advice, and then how would we prevent it in the future? So that if you were to get bad advice from somebody or get advice from somebody, what do you do with that, and how do you handle that properly so that you make the best decision you can? But also, if you did make a mistake like this guy did, it's not too late to course correct, and
right.
There's hope in this as well. This guy's not doomed for poverty because of this decision, but we want to learn from it. So,
yeah. Yep.
So the first thing, what is the advice that he was given? Just to reiterate it.
Well, he was told not to even save, really, until the market crashed.
Yeah, exactly. The market's about to crash. Don't invest yet. Wait for the bottom.
Not even invest, though. It was don't save your money until the market crashes.
Yeah, right. I guess by nature, yeah. I'm sure the dad meant like the 401k, it's going to get invested, so just don't do that.
Yeah.
And the guy just took that and ran with it and go, well, I'll only contribute 1%. But
yeah, you can do a 401k without investing, but
yeah, I think is that. Oh man, this is it. Do you have to have some kind of like stable fund in a 401k plan or a cash equivalent?
I think it's a requirement. I'm not 100% on all the 401k laws and everything, but I'm pretty sure. I don't think I've ever seen a 401k where that's not an option.
Yeah, so you could just treat it like a savings account and have minimal growth on it, which we wouldn't necessarily recommend. But
at least you're getting the match.
Exactly. Yeah. If your company's offering, hey, if you put in 5%, we'll put in 5%. And you put in 1%, well, you're not getting that.
Yeah.
Maybe they match 1%. I don't know. Maybe you have to get to the 5% for them to do anything. So it sounded reasonable at face value, like, oh, if the market's about to crash, well, I don't want to start buying now. Oh, okay, that's not a completely unreasonable thing to think.
Yeah.
But ultimately, you can't time the market.
Yeah.
You actually don't know that. And
right.
in this case, the market didn't crash for 3 more years.
Yeah. Yeah. It's funny with the markets. I'm sure there are other examples where people mistakenly think that they know the future, but it's just funny with the markets in that I feel like everybody thinks that they know the future,
right?
And it's a very what's the phrase, Monday morning quarterback, or the past the phrase 2020 whatever.
Yeah,
hindsight is 2020. Yeah. Yeah, I feel like you really get that with the markets. And I was thinking, so like in 2020 with COVID, you could look at that and think, oh, obviously the markets were going to crash because of COVID. But then like we had in the early 2000s SARS, and I think I was in college with swine flu. Mm-hmm. And so I very distinctly remember in I think it was around Christmas of 2019, hearing about COVID and just thinking, oh, it's going to be another one of these like SARS. It's in Asia for a little bit and then it just kind of dies out. So we didn't know the future. We didn't know that it was going to come to the U.S. and cause this global pandemic that created what was just a blip in the market, but for a little while it was a rough blip.
Mm-hmm. Yeah, there's a popular investment guy that tends to overpredict crashes, and there's a popular like jab at him that's just like he's predicted 5 of the last it's 20 of the last 5 market crashes or something like that. He's always predicting it basically, but he's only right a couple of the times. So to do this right, you have to time 2 things perfectly: when to get in and when to get out, and it's really almost impossible to do that.
Yeah,
certainly to do it consistently. You get lucky, but again,
nobody knows the future.
Mm-hmm. So the best advice from our perspective is just get started and just keep going. Yeah. And we believe in like when you're like a 401k is a great example of this. You're just continually contributing to it every paycheck, so you get the benefit of dollar cost averaging. And no matter what the market's doing, you're profiting off of it, because when the market's down, markets do go down, you get in at a lower price, and when markets go up, obviously your portfolio goes up. So it's kind of a win-win when you're in the season of just saving. Just do it. Yeah. Like it's not a reason to just go, I'm going to wait here. It's about to crash. Like just just keep doing it.
Yeah.
You'll thank yourself.
Yeah. To your point about getting both the out of the market and the into the market correct, there's an indicator that people look at where they take a look at sell side analysts. So essentially, what does Wall Street think? How much does Wall Street think you should allocate to equity for your portfolio? The more bullish Wall Street gets, is typically, it's a contrarian indicator. It typically means that danger could be coming.
Interesting.
So yeah, it's really hard to predict.
Yeah. Yeah, even the best of the best, the pros can't do it, and nor do they even really try to, because they know better. And we talked about last week Jack Bogle and how he created the index fund as a way to sort of mitigate some of this and just buy the whole market and let it ride, kind of a thing. That's again, we don't necessarily agree with that. That should be your investment philosophy yourself, and we do more broadly than that. At Stonecrop, we're not just buying indexes, but nevertheless, the principle is sound that just keep buying into it. Over time, those decisions will pay off in the long run.
I also like to think of like various house chores as a good example of listening to people who do it every day. When we first bought our house, a few of the outlets weren't working, and I have a friend who's an electrician. I called him, and he came out and took a look, and he fixed the outlets. But he laughed and he said, whoever owned this house last seemed to know enough about the electric systems to be to be dangerous, to kind of know what they're doing, but a lot of this wasn't done quite right. So he's like, I wouldn't be surprised if you call me for some other things in the future, just because this person kind of knew what they were doing, but not all the way. So listen to the professionals.
That's right. So on that note, listen to the professionals. Let's go then to the next section. What the source of this advice was a trusted person. It was his own dad, and his mom backed him up. So these are people that you inherently trust, assuming you have a good relationship with them and they raise you right. Like, you should trust your parents.
Yeah,
absolutely. However, I think there are limits to not everybody knows everything. Your dad, breaking news, doesn't know everything about everything.
Right.
So he probably can't give you advice on like serious medical advice. You know what I mean?
Yeah.
Like, you probably wouldn't listen to your own father who's telling you that it looks like you have cancer and you should go get chemotherapy. You should probably talk to a doctor about that. Same thing goes with finances. Your dad might be really smart and even have success with his own finances, but he doesn't necessarily have the best advice to give here. So you should at least run it through a secondary source.
It's funny the way you just said that. I wrote in my notes, there's a real temptation to want to know everything about everything, but that's not possible. So yeah, on the same page there.
Yep. Yeah, you wouldn't take legal advice from your best friend just because they watched some true crime documentary and feel like they know everything about that one trial that they watched.
Law and Order.
Exactly. Yeah. Like, it's not smart. Same thing with finances. It's wise to seek professional counsel when contemplating a big financial decision.
Yeah, because you can make irreversible mistakes.
Exactly. And trusting the person does not equal trusting everything they have to say about everything.
Right.
It's not a lack of love if you take advice from your parents and just go, okay, I'm going to talk to my financial advisor friend and see what he thinks about that. Like, that's not unloving to just not. It might feel like it, and maybe you don't even have to tell them that you're not going to take their advice, but just because you trust the person doesn't mean you should trust their advice. And
also ask questions. Know enough to just kind of ask why they're providing that advice. Maybe I think something that a lot of people, especially in this specific example, forget is that fear sells. Again, I'm going back to COVID, but do you remember, I think it was John Krasinski created that. Only Good News or whatever. I haven't heard about it since.
Yeah.
But every other all the other news still keeps selling bad news.
Right.
So fear sells, and it's likely that this dad was just watching CNBC or whatever, and they were saying, "Oh, the crash is going to come."
Yeah. Yeah. And I think in this particular instance, the son really should have, like I mentioned, been tipped off when just thinking about his own dad's investing career or life. Well, he hasn't done it.
Yeah.
So I think asking the questions, and when it comes to, if you're getting advice from somebody, well, does this person invest? Have they built any level of wealth and success? Like, do they clearly know what they're talking about? In this case, the dad might have done well for himself without investing. That's possible. I know somebody that's very, very successful, very wealthy, and has never invested $1 for whatever reason. He just doesn't trust it. So that's possible, but I don't think that you should be really necessarily taking the investment advice from somebody who's never done it.
Right. And even if they have, people don't like to admit when they're wrong.
Yeah.
I mean, I would much rather and enjoy talking about, oh, I invested in this stock that went up 300% or this one that went up 500%. But I've got a whole list of stocks that went down 50%.
Yeah.
That I don't talk about as much.
Yeah. You're admitting that.
With a small portion of my portfolio.
So you knew enough not to go crazy on those stocks.
Yeah.
Yeah.
It's just fun.
Yeah.
Just fun money.
Fair enough.
Danielle hates when I use that term, but whatever.
Yeah. Are they just parroting headlines that they heard on CNBC, as you said?
Right.
Or are they doing lots of research? Have they dug into this themselves and have their own well-formulated opinion about it? Most likely not.
Yeah.
And you should probably just, yeah.
And you can create a well-formulated opinion and make certain moves that don't include the drastic don't invest.
Right.
You can de-risk a little bit, or if you think the opposite, you can increase risk a little bit. But typically, the typical advice is not just go to cash or keep your money in cash.
Right. For sure. So we've already kind of hit on some of this, but so the advice, don't invest, the markets are about to crash. The source was his father, and the error was just not filtering that advice through the right lens. It's okay. You'll probably receive lots of advice throughout your life. Some good, some bad, some kind of in the middle. When it comes to your financial life, you should probably, at the bare minimum, just get a second opinion. We hear this all the time in the medical community. If you go see a doctor who's a highly trained professional, who knows what they're doing, and they give you a diagnosis, and it's maybe a life-changing diagnosis, you might go, I'd like to get a second opinion on this. And you go see a different doctor and see if they verify that or not. Because if they do, well, then there's a good chance that that's true. If they don't, well, now you have conflicting diagnoses. But nevertheless, it's probably good that you did that, because you may go, okay, well, maybe I don't need to jump into this radical treatment. Maybe I need to get a third opinion now and try to figure this out. But the same thing should be true of our financial life. Get advice from somebody, and then let's go get a second opinion. Let's run this by somebody that I know knows what they're doing with finances, and let's see what they think.
Yeah. Yeah, even if you're talking, yeah, well, I mean, basically you just said that. So in the example, it was listening to dad. You should probably go talk to a financial advisor. But also, if you're thinking about hiring a financial advisor, you should probably also talk to two, just to make sure that one is making sense is competent and making sense over the other.
Yeah. Yep. Proverbs 11:14 says, where there is no guidance, the people fall, but in the abundance of counselors, there is victory. So it can never hurt to get another opinion. Obviously, you can take that too far and just seek endless opinions, and then you're just you have too many voices that you don't know which one to trust.
And just never make a decision.
Yeah, you could have that decision fatigue or whatever, but
analysis paralysis.
Right. So try to come to some decision at some point through a variety of counselors that you do trust.
Yeah. There's also Ecclesiastes 11:2, divide your portion to 7 or even 8, for you do not know what disaster may happen on earth. Kind of a good verse about not necessarily just investments, but diversification.
Yeah. Diversification of advice.
Diversification of advice, or even, again, bring it back to this example. Dad said, keep everything in cash. You should maybe, keep some in cash, but diversify.
Yeah. Yeah, and even if that guy did that, he would have been much better off if he had just done the 5% to 5% match and just put it in a cash position in that 401k. But I think he took that advice. I'm not convinced that that's what his dad was telling him to do. Don't contribute anything to it. I just it was just a massive blunder on this guy's part to just not contribute anything or just contribute 1% when he didn't have to invest that money if in fact a crash was coming. But yeah, so lots of errors, just not getting a second opinion, not talking to a trusted financial professional, not thinking about the employer match and what this really was and what he was missing out on. That's just a huge oversight on this guy's part, that he wasn't thinking about this match that was his company offering him free money if he just contributed a little bit. So yeah, at Stonecrop, we don't predict crashes. We're not trying to tell our clients, here's when you should get in. We're not trying to time the market at all. We build plans that survive them. We build financial plans with the volatility in mind so that we can be prepared for anything.
Yeah. I mean, we'll move portfolios based on what we see, not in and out of the market, but we might toggle risk up a little bit or down a little bit. So there's value in that, but not the ins and outs.
Yeah. Let's talk about the cost of this mistake. You ran some numbers.
Yeah, and if this guy's listening, I'm going to make him kick himself even more.
All right. So let's hear, what are some of the analysis that you ran here, some of these numbers that you put together?
Well, spoiler, the overall theme is he missed out a ton on his match and just saving in general. But I took a look at, I actually just, if you look at some of the government number, you can get, I was surprised. You can get surprised by the number, but you can get personal income data, average personal income data from the U.S. government. And so I just took kind of 3 years. So I went back 3. So in 2023, the average personal income in the U.S. was $40,000. That was surprising to me.
Yeah.
But I guess that's for 15-year-olds and older. So I guess if you're aggregating like people making 10 to 15 or whatever an hour, all the way up to your everyday person.
Is that average or median?
Median.
Okay.
I don't remember what I said, but it was definitely median.
Yeah.
So that's what I started with, $40,000. And so I assumed this kid does the full 5% match. So one scenario, he's doing the full 5%, or he's contributing 5% and receiving a 5% match. So effectively 10% of his $40,000 is going into his 401k. And then the next scenario, I assumed he's putting 1% in and getting a 1% match.
Okay. So 2% of his salary versus 10% of his salary getting contributed ultimately.
Yep. So in the my first analysis was, if in the first 3 years he's averaging minus 20% in the markets, and some people might hear minus 20% and think, oh, that's not a big deal. Like the Great Recession, the markets did like minus 50. This is minus 20% per year for 3 years. So that's a ridiculous crash.
So that's the dad just nailed that prediction.
Yeah.
And the dad's like, yes, the market crashed 3 straight years.
Yeah. So in that scenario, again, it's the saving is key, because in that scenario, by the end of year 3, he's at $8,080. So, he's put $12,000 and he's down to $8,080. And
with a 5% match.
Right, yeah. With the 1% match, he's at $1,615.
Right.
$1,615. And then after those first 3 years, I just assumed in all scenarios a 7% average rate of return. So if he gets to 85 and he's done that, he's where he matched early, he's at 5.9 million. Where he only does the 1% match for the first 3 years, he's at 5.5 million, and then by age 95, it's 11.6 million versus 10.8 million.
Yeah. So it's a $500,000 difference at age 85. But even let's just not go that far out. Let's look at age 30. So 8 years later, he's got about $48,000 in a 5% match situation compared to $38,000. So he missed about $10,000 after 8 years of doing this and only contributing 1% in one versus 5% in the other. So and that's when the market crashed 20%.
Yeah. So that's best case. Dad nails it.
Yeah. He still loses $10,000.
Yeah.
All right. What's the next one?
The next one is down 10% in the first 3 years. So Dad's kind of right still.
Yep.
And these just continued to get better. So after the first 8 years, he's got a portfolio value of about $51,000 versus $39,000. At age 85, he's at $6 million versus $5.5 million, and at age 95, he's at $11.8 million versus $10.8 million.
Yeah. Yep. After those 3 years, just 3 years of doing that, he's lost about $8,000 because he $10,000 versus $2,000 in his account.
Yeah.
So Dad still kind of nails it, only 10% down. Next one is what?
Next one's 0. He makes nothing each year. So this one is just keep it all in cash, but keep saving. So at the end of 3 years, he's at $12,300 versus the 1% he did at $2,400. In 8 years, he's at $54,000 versus $39,500. And then you go out to age 85, that turns into $6.2 million versus $5.56 million. And then age 95, $12.15 million versus $10.94 million.
Yep. So this one speaks to had he just kept it in cash, which is like that would be like the most conservative thing we would recommend. We wouldn't recommend that, but if he took his dad's advice, and I think this is what his dad wanted him to do.
Yeah.
I think that's my best guess is don't miss out on this match, but just don't invest it.
Right. Yeah. And then I've got a couple that make it look even better. So if he makes 5% per year, at the end of those 3 years, he's at $13,600. With the only 1% match, he's at $2,700. When he's at age 30, so 2031, he's at $56,000 versus $40,000. At age 85, he's at $6.25 million versus $5.5 million. And at age 95, he's at $12.3 million versus just under $11 million.
I realize we're throwing a lot of numbers out here, so I'm going to see if I can have the numbers up on the screen again, so people could actually see it if they're watching this on YouTube. If you're listening in the car,
tough,
too bad.
Yeah.
Right.
And then the final one, he kills it. The market just does really well. And that's so since 2023, the market's done pretty well. I'm not going to say it's anywhere near 20. I'm not going to say you would have gotten anywhere near 20% necessarily, but
that's what this is showing.
Yeah.
First 3 years are at 20%.
First 3 years, 20%. At the end of those first 3 years, he's just under 18,000. Versus the 1% match and getting the 20%, he's at about $3,500. At age 30, he's at $62,700 versus the $41,200 with 1% match. At age 85, he's at $6.5 million versus $5.6 million when he was only taking the 1% match. And then at age 95, he's at $12.8 million. And if he had only taken the 1% match for 3 years, he's down $1.8 million at age 95.
Right. Yeah. So real dollars that obviously it gets more drastic over time. The more compounding runs its course.
Right.
You'll see that spread start to widen. We didn't obviously run this out to the full 10-year period that he kind of did his calculation off of, where he calculated somewhere between $40,000 and $55,000 that he missed out on in that 10-year period. So I think it sounds like the markets did really well for those 3 years before they crashed a little bit, but then likely just recovered in the 6 years to follow that. And he ran some numbers, and it's somewhere in his mind somewhere between $40,000 and $55,000 that his portfolio is now less valued at.
Yeah.
As a result of the decision he made.
Mm-hmm.
So it set you back. That's a good chunk of money in a 10-year period to not have in your portfolio.
But it also, I'll say the other reason it's valuable to talk to somebody who spends their days looking into people's finances is because it might make sense not to do the match. If you're a dual income family and one of the two incomes is gone for some reason, then maybe you just need the cash flow. Mm-hmm. If you're saving for a house, maybe you need the cash flow. So that's, let me see. I think in the case where, say dad does nail it and the market's down 20%, or I think even if I'm just going to double check real fast if it's down. So say at the end of 3 years, this kid wanted to buy a house and needed to take $10,000 out of his portfolio. Then yeah, he's being too risky with $10,000 that he absolutely needs. Does that make sense? Am I making sense there?
I think so. Yeah.
So yeah, so market's down 10%. He does the saving, and then he needs to take $10,000 out. So obviously he should still save. But if the market's down 20 or 10, and all of your money's in the market, it would have been better if you just saved and not put it in the market because you needed that money in 3 years.
Yeah.
So time horizon, basically what I'm trying to say is time horizon matters on whether or not you're going all in on investing. But no matter what you're doing, no matter what your goal is, if you can save.
Well, yeah, and I think our advice has been consistent from the get-go that you would still be missing out on the 5% employer contribution if you're not doing this. And so your cash flow, I don't think, should be so tight that is your only savings. That if that's all you can contribute and that's all, like, just to get that match, but then you have such little cash flow left over, I think your cash flow should be such that you're doing that to get the match and you just kind of set that and forget it.
Yeah.
But you also have a healthy chunk that you're saving. Maybe it's in cash for a little while to build up the emergency fund or to save for a house, and then it turns into taxable investment savings where you're saving to a brokerage account where you can just keep piling money into there and building a separate investment account that's not a retirement account. I think you should be doing both. So that
I'm just thinking of like why cash flow might be tight. So you lose an income maybe for the few years that you have multiple kids in college, things like that, where you might not be. You're losing on the match, but you would be losing otherwise if you're just getting the match to pull out of like other retirement money or something. Because
for sure,
yeah.
But I think setting yourself up with sound financial principles from the get-go, allowing yourself to get that match always, so you don't lose out on that, but still having the flexibility and the margin to be able to save extra so that you never do have to toggle that back and lose out on that. Because ideally, you would just be able to get that match until you retire. Yeah. Because it's just, again, it is free money. It's part of your compensation package, essentially, that your employer's offering. Hey, we'll give you 5% of your salary in addition. As long as you just save something for yourself, we'll match that.
Yeah. Yep.
So how do we fix this? How does this guy fix this situation? All is not lost. He can recover, though he's made a mistake. The good thing is he recognized it and made some changes early on. After a few years, he realized what he was doing. He brought it down to 0% for a 6-month period, I think. But then he went back and upped it to the full 5%, which is good. I think the important thing is, like, we've shared this proverb. It's not a scriptural proverb, but the tree one. The best time to plant a tree was 10 years ago. The second best time is now. If you've made mistakes, we're all going to make mistakes. Yeah, but you can fix them. So get back on the right track.
Yeah. Yeah, you can fix your financial situation. I would say don't wait. Time's a big asset that people kind of
and you'll never get those years back.
Yeah. That's all I'm trying to say.
Yeah. Of course. But you still have years ahead.
Right.
So let's make some adjustments now. And maybe it means you actually have to contribute more now. Maybe it means you have to go 6% to maybe 10%. Maybe you have to really increase your contributions now because you've missed out on those years.
Right. And maybe work to 66 instead of 65.
Right. Decrease your living expenses so that you can save a little bit more. Figure out a way you can get creative. Get a second job and make more money so that you can save more money. Use your bonuses to invest and not to spend. I think the important thing is mistakes aren't final. We're all going to make mistakes. Yeah. Nobody's perfect. None of us have lived or ever will live perfect financial lives, even Warren Buffett. We're all going to make mistakes along the way. The key is recognizing it and being willing to course correct.
Yeah, absolutely.
A better way. Moving forward, what instead of having to course correct, obviously in this guy's situation, we can't go back and have him change his decision 10 years ago. But for anybody that might be in a similar situation that has gotten advice that they're about to take action on, make sure you're just running it by a trusted financial advisor that we talked about.
Yeah.
Talk to us if you want.
Most of the time, the advice is going to be get free money.
Yeah. 100%. And just stay consistent with it. Yeah. We talked about time and discipline are your two best friends, even more than your income. Time and discipline in investing is going to pay off more than just having a crazy high income.
Right. Yeah. The magic of compounding just is mind blowing sometimes when you look at actual numbers.
Yeah.
When we run plans for like clients' kids who are 20 years old, and we say, hey, start saving $500 or whatever, and the money that they might end up with at age 65 or 95 or whatever is starting to get into like the billions.
Yep, it's wild. Yeah, so obviously the earlier you can start, the better. But for none of us can, again, wind the clocks back and start earlier. We have to start today if this is where we are. So just start and let it run its course. But I think going back to the kind of the second opinion idea, we're all familiar with getting a second opinion if we get a medical diagnosis. How much more should that's a highly trained professional that gave us that advice that we're still not trusting totally, and we want to get a second opinion. How much more?
Even I think you and I at one point went over how we both got second opinions on car inspection.
Oh, that's right.
Costs that we didn't want to pay.
Yeah. How much more if it's just a friend or a parent who's not a professional in that field, or maybe it's ChatGPT. We should probably run that advice that you're getting by somebody that knows what they're doing, and just make sure that it's sound.
Yeah. I have been finding, maybe we should do an episode on this at some point. I've been finding more and more potential errors in some ChatGPT advice, financial advice.
Mm-hmm. I think ChatGPT is getting worse.
I do too. Although I not to get on a ChatGPT side tangent, but I just noticed that you can switch it to like immediate feedback or think longer, and think longer seems to be better. I think pretty intuitively, but whatever.
Yeah. It's certainly don't get all your financial advice from ChatGPT
or Reddit.
Yeah.
Or somebody else recently turned me on to.
At least Reddit's real people, but
right. But I can't remember I just got into some Facebook group that a client recommended, just for me to be aware that there are Facebook groups like this where like I think there are like 1 million members in this Facebook group where they're all giving each other financial advice based on like, so similar to Reddit, but it's on Facebook.
Yeah.
But yeah, it's just interesting to see. Yeah. Don't listen to random strangers on the internet.
Exactly. Look at the advisor's own life. Do they practice what they're teaching? Are they telling you to do something that they themselves are not doing? Have they been planning doing this for decades and they have a clear track record? I remember I used to, like when I took guitar lessons, when I was learning how to play guitar, I would immediately be like, well, I want to know that my guitar teacher can play the things that I want to play, because I don't want to be learning from somebody that doesn't know what they're doing. Like I want to make sure that they can actually shred before I start getting lessons from them. Same thing with like when I was in school and I would hear teachers, like I would have teachers, and I would immediately kind of have this skepticism, like, do you really know everything that you're trying to teach me, that you're telling me that I need to know? I want to make sure you know it.
As they're like reading from their book.
Yeah, exactly. So
what, can you think of any good questions that you would ask an advisor to kind of vet that out?
Yeah, I don't know how much an advisor would be willing to share of their own personal financial life.
Maybe the only one that immediately comes off the top of my head is, do you invest in this manner?
Yeah. You don't have to get to the specifics, but just, are you doing what you're telling me to do?
Yeah.
Or did you at some point, and now you've moved beyond that. Maybe it's just an emergency fund or kind of early stage financial wisdom. Did you do that too? Mm-hmm. And then how did that go for you?
Yeah. Yep.
Yeah. And we talk about this too at Stonecrop, that we want to be that, like we want to be that way. We want to be practicing what we're preaching as best we can. And if we're recommending a client do something, that we would be taking that same advice if we were in their shoes.
Yeah.
And being, yes, I would do that too if I were you.
Yeah. And there can be differences. Like we run into a lot of clients who have different opinions about, do I want to specifically save to pay to fully fund my kids' college education, or do I want to give them some type of amount for them to choose? And in that case, the recommendation is different. So there's always, there should always be customization based on what you want as a person, but there are also just sound principles like, do the saving.
Yeah, right.
What you desire might should definitely influence how you save it, in which type of account you save it. But yeah, make sure that there are principles that are being followed.
For sure. Any other thoughts? Any other closing thoughts on what should have done, what should have been done, what could have been done to prevent this guy, or anything else that we haven't talked about already?
I don't think so. I mean, I wonder, was there any background on, did this person go to college? Were they?
I read the whole post in that cold open. That was the whole context, and it was just got his first real job at 28 and with benefits and 401k and stuff. And
okay, I ran all of my numbers at age 22. I just assumed, guy's right out of college, and
no, it's a little bit later in life too, which is a shame for this guy that not only did he miss out from 28 to 38 because of this decision, but that he was starting at 28, not at 22.
Yeah. The only other closing thought I was thinking of, I don't remember why I got to 28 and everything, but I think everybody should set themselves up with some kind of foundation.
Mm-hmm.
I remember in high school, so I mean, I ended up getting into this career, but I think even if you have no interest in getting into the financial career, everybody should have probably take some kind of like econ course or personal finance course or something. I remember for people who weren't in the finance major in my college, there was like a personal finance elective class you could take, things like that. So yeah, just try to educate yourself. I would say that's another piece of advice for people who aren't necessarily interested in finances, but want to at least set themselves up for some kind of success in finances.
Yeah, I don't know why that. Maybe it's becoming more popular, but I feel like I hear it all the time. Certainly when I was in school, personal finance was not certainly not a requirement. I don't even remember the option for anything like that in high school or anything like that. That would be a really helpful thing for a high school student to get some sound financial principles right from the get-go. You're starting your first job at Rita's or some other, McDonald's or something. What do I do with that money? It's not a lot, but I also don't have to pay rent or, I'm just living at home, so I could probably do more with it and start putting that into a Roth IRA and making some of these sound decisions right from the get-go. It'll pay off. So
I remember going to my parents and even asking them, like, how do I fill out a check?
Yeah, right. Totally. That would be helpful stuff to know, to teach kids.
I wonder how many people still use checks. I think the only time I use them now is church.
Yeah.
But yeah, don't need to go off on that tangent, but try to get some kind of understanding of personal finance before you hit the real world.
Yeah. And I think the big takeaway is not to just inherently distrust your parents or anything like that, or even your friends or anybody that's going to give you advice. It's just verify it.
Yeah.
Run it through another trusted source and make sure that it's the wisest decision for you.
Right.
Well, this is fun.
Yeah.
Thank you for listening. Tune in again next week.
We'll count on you for more Reddit tidbits.
We'll see. Thanks for listening, and God bless.
God bless.
Investment advisory services offered through Stonecrop Wealth Advisors, LLC, a registered investment advisor with the U.S. Securities and Exchange Commission. This material is intended for informational purposes only.